Picture this. It's August 15th, 1971, a Sunday night. Most Americans are watching Bonanza on television. The president interrupts the broadcast. Richard Nixon, sweating under the studio lights. He announces that the United States will no longer convert dollars to gold. Just like that. No warning, no debate. The entire global financial system changed. And here's the uncomfortable part. Most people watching that broadcast had no idea what he just did. They went back to their TV shows, went to work on Monday, bought groceries, paid their bills. Everything seemed fine. 53 years later, we're still living inside that decision. By the way, I'm Ben, and you're watching Ben Invest, where I explain financial decisions and secrets. Let's continue. Here's what you need to understand right away. There's a war happening. Not the kind with tanks and missiles. A slow, quiet war between two ideas of what money should be. On one side, the US dollar, backed by trust, military power, and the largest economy on earth. On the other side, gold, backed by nothing and everything. Gold doesn't promise you anything. It doesn't pay dividends. It doesn't innovate. It just sits there. A chunk of metal that humans have obsessed over for 5,000 years. The dollar promises you stability, liquidity, growth. It's the blood of modern commerce. $75 trillion of it circulating through the global economy every single day. So why are central banks around the world buying gold at the fastest pace in 50 years? Why did China's central bank add 225 tons of gold in 2023 alone? Why are countries that depend on the dollar for trade quietly stockpiling the one asset that directly competes with it? That's the question we're going to answer. And the answer is going to make you look at your savings account very differently. Let's go back. Before Nixon, before the television announcement. In 1944, the world was still burning. World War II. Entire economies destroyed. Currencies worthless. Europe in ruins. And in a hotel in New Hampshire, representatives from 44 countries met to redesign the global financial system. The Bretton Woods Conference. The idea was simple. Every currency in the world would be pegged to the US dollar, and the US dollar would be pegged to gold. $35 per ounce. Fixed. Guaranteed. If you held dollars, you could exchange them for gold at any time. The US Treasury promised this. They had the gold reserves to back it up. More than 20,000 tons sitting in vaults. This system worked. For a while, post-war boom, European reconstruction, American dominance. The dollar became the world's reserve currency not because of force, because of trust, because it was as good as gold. But there was a problem. The US government was spending money it didn't have. The Vietnam War, social programs, infrastructure, all of it required more dollars than there was gold to back them. By 1971, foreign countries started to notice. They started showing up at the Treasury window with their dollars, asking for gold. France did this aggressively. Charles de Gaulle didn't trust the Americans. He wanted his gold. The math was simple. The US had $78 billion in circulation, but only $10 billion worth of gold. Nixon had two choices. Admit the US was broke, or change the rules. He changed the rules. He changed the rules. That Sunday night broadcast, August 15th. Nixon called it a temporary suspension, just until the economy stabilized. Temporary. It's been 53 years. What Nixon actually did was sever the last link between modern money and physical reality. After 1971, the dollar wasn't backed by gold. It wasn't backed by anything tangible. It was backed by a promise. The full faith and credit of the United States government, which sounds reassuring until you realize what it actually means. It means the government can create as many dollars as it wants. No natural limit, no physical constraint, just a printing press and a decision. Economists call this fiat currency. Fiat. From Latin, let it be done. Money by decree. Money because the government says it's money. And here's the weird part. It worked. The dollar didn't collapse. In fact, it got stronger. Not immediately. The 70s were a mess. Inflation, oil shocks, economic chaos. But by the 80s, the dollar was more dominant than ever. Why? Because the US made a new deal, not with gold, with oil. In 1974, the US struck an agreement with Saudi Arabia. The Saudis would sell oil exclusively in US dollars. In exchange, the US would provide military protection and support. This changed everything. If you wanted oil, you needed dollars. Didn't matter what country you were in, didn't matter what currency you used domestically. On the global market, oil was priced in dollars. And since every country needs oil, every country needed dollars. The petrodollar system was born. Suddenly, the dollar had a new form of backing. Not gold. Black gold. Petroleum. The most critical commodity on Earth. Countries had to hold dollar reserves, had to keep dollars in their central banks, had to accept dollars as payment, because without dollars, you couldn't fuel your economy. This gave the US an extraordinary privilege. It could print money and export the inflation. Other countries would hold those dollars, would absorb the excess supply. The US got to run deficits without the normal consequences, because the world needed dollars more than dollars needed the world. But, and this is important, this system only works as long as everyone plays along. Let's talk about gold during this period. After 1971, gold was supposed to become irrelevant, just another commodity, no longer money, no longer the foundation of the global system. For a while, it seemed that way. The price of gold went wild in the 70s, spiked to $850 an ounce in 1980, then crashed. Spent the next 20 years in decline. By 2001, gold was trading at $255. An afterthought. A relic. Central banks were selling it off. The Bank of England famously sold half its gold reserves between 1999 and 2002. At the absolute bottom of the market, financial experts said gold was a barbarous relic, that modern economies had evolved beyond it, that holding gold in reserves was wasteful, irrational. But then, something shifted. In 2008, the financial system nearly collapsed. Lehman Brothers, bank bailouts. The Federal Reserve started creating trillions of dollars out of thin air, quantitative easing, emergency measures, temporary measures. Except they never stopped. The Fed's balance sheet went from $800 billion in 2008 to $9 trillion by 2022. Think about that. $9 trillion. Created. Not earned. Not taxed. Just manifested into existence. And suddenly, gold didn't seem so barbarous anymore. The price climbed. $400, $600, $1,000, $1,500, $2,000. In 2024, gold hit $2,600 an ounce. But more importantly, central banks stopped selling, they started buying. Here's where it gets interesting. In 2010, central banks were net sellers of gold. They were reducing their reserves, following the conventional wisdom that gold was dead weight. By 2022, they were buying over 1,000 tons per year, the highest level since 1967. Who's buying? China, Russia, India, Turkey, Poland, Singapore. Notice a pattern? These aren't random countries. These are countries that have complicated relationships with the US dollar system, countries that have been on the receiving end of sanctions, or fear they might be. When Russia invaded Ukraine in 2022, the US and Europe froze $300 billion of Russian central bank reserves. Just lock them. Inaccessible, Russia had stored those reserves in dollars and euros, in Western banks, and in one coordinated move, that wealth was neutralized. Every central bank on Earth watched that happen and bought the same thing. If it can happen to Russia, it can happen to us. You can't freeze gold. You can't sanction gold. If it's sitting in your vault, in your country, it's yours. No counterparty risk. No political leverage. This is why China is buying. Not because they think the dollar will collapse tomorrow. Because they want options, insurance, a hedge against a system they don't control. Now, let's talk about what the dollar actually is today. It's debt. That's not an exaggeration. Every dollar in existence is created through debt. When the government wants to spend money it doesn't have, the Treasury issues bonds. The Federal Reserve or private banks buy those bonds, and new dollars enter circulation. The U.S. national debt is currently $34 trillion. And growing. 34 trillion. That number is so large, it stops meaning anything. So let me put it differently. The US government pays more in interest on that debt than it spends on defense, more than it spends on Medicare. Just the interest. And the only way to pay that interest is to issue more debt, which creates more dollars, which devalues the dollars already in circulation. This is the trap. The system requires constant growth, constant expansion. If the money supply stops growing, the debt becomes unpayable. If the debt becomes unpayable, the system breaks. Gold doesn't have this problem. There's no gold debt. You can't print gold. The supply grows at roughly 1.5% per year through mining. Slow, predictable, finite. The dollar supply can grow at whatever rate the Federal Reserve decides: 5%, 10%, 40%. In 2020, they increased the money supply by 25% in a single year. 25%, 1 year. And then everyone acted surprised when inflation hit 9% in 2022. Here's the irony. The dollar is still the dominant global currency, still the reserve, still the most liquid, most trusted, most widely used money in the world, and it's losing ground, not dramatically, not all at once, but slowly, measurably. In 2001, the dollar accounted for 73% of global central bank reserves. In 2024, it's 58%. That might not sound like much, but in the world of central banking, that's a massive shift. Where's that percentage going? Some to euros, some to yen, some to yuan, and some to gold. Gold's share of global reserves has been quietly climbing, from 10 to 15%. Countries aren't announcing it, aren't making grand statements. They're just buying. Steadily, month after month. China is the most opaque about this. They report gold purchases, but analysts believe the real numbers are much higher, that they're buying through back channels, through Hong Kong, through private entities. Why hide it? Because if China suddenly announced they're dumping dollars for gold, it would send shockwaves through the system. The dollar would weaken. US interest rates would spike. It would be a declaration, a challenge. Better to move quietly, slowly, without triggering a panic. But the trend is unmistakable. The world is diversifying away from dollar dependence, and gold is a major part of that diversification. Let's zoom out. What does this actually mean for you? If you live in the US, you're paid in dollars. Your savings are in dollars. Your retirement account is mostly dollar-denominated assets. You are, whether you realize it or not, betting on the dollar system continuing to function, and maybe it will. Maybe the dollar remains dominant for another 50 years. The US still has the largest economy, the strongest military, the most innovative companies. But the cracks are visible. The debt is unsustainable. The inflation is real. And the trust is eroding. Every time the US uses the dollar as a weapon, freezes assets, imposes sanctions, it reminds the rest of the world that the dollar is not neutral. It's a tool, controlled by one country. Gold is neutral. It doesn't care who you are. It doesn't have foreign policy. It doesn't require trust in any government. That neutrality is becoming valuable again. Now let's address the counterargument. Because it's a good one. Gold doesn't do anything. It sits in a vault. It doesn't generate returns. It doesn't drive innovation. Holding gold is economically unproductive. This is true. If you put $1 billion in gold in 1971 and left it there, you'd have about $94 billion today. Adjusted for inflation, a decent return. If you put that same $1 billion in the S&P 500, you'd have $340 billion. So why would a rational actor choose gold? Because sometimes the goal isn't maximum return. Sometimes the goal is preservation, security, survival. Central banks aren't trying to beat the stock market. They're trying to ensure their country can function if everything else falls apart. Gold is catastrophe insurance. You hope you never need it. But when the catastrophe comes, nothing else will do. Here's a scenario, hypothetical, but not impossible. Imagine the US dollar loses its reserve currency status, not overnight, but gradually, over 10, 20 years. Countries start pricing oil in multiple currencies. Trade agreements bypass the dollar. Central banks hold smaller and smaller dollar reserves. What happens? The US can no longer export its inflation, can no longer run trillion-dollar deficits without consequence. Interest rates spike. The government has to choose between paying its debts or funding basic services. In that scenario, what's valuable? Not dollar-denominated bonds, not cash, not financial assets tied to the health of the US economy, hard assets, real estate, commodities, and yes, gold. This is the nightmare scenario, the one policymakers don't talk about, Because even discussing it undermines confidence, and confidence is the only thing holding the system together. Let's be clear, the dollar isn't collapsing tomorrow, probably not in your lifetime, but the trend is unmistakable. Slow de-dollarization, rising gold reserves, countries building alternatives to the dollar system. BRICS nations are exploring a common currency. China and Russia settle trade in yuan and rubles. The European Union is pushing for euro-denominated energy contracts. None of this kills the dollar, but it chips away at its dominance, and dominance is what gives the dollar its power. Without dominance, the US loses its exorbitant privilege, the ability to borrow cheaply, to print without immediate inflation, to fund its military and social programs without hard choices. Gold doesn't care about any of this. It's been money for 5,000 years. It will be money for another 5,000. The dollar is 53 years into an experiment in whether money can exist purely as belief, purely as collective agreement. So far, it's working. But history suggests it won't work forever. Every fiat currency in history has eventually failed. The Roman denarius, the French assignat, the Weimar papermark, the Zimbabwean dollar. All of them started as trusted, stable money. All of them ended as worthless paper. The dollar might be different. It has advantages no previous currency had: global reach, military backing, network effects. But it also has vulnerabilities no previous currency had: 34 trillion in debt, a political system that can't agree on basic budgets, enemies with nuclear weapons, and economic ambitions. So here's a question you have to ask yourself. What is money? Is it a piece of paper with a president's face on it? Is it a digital entry in a bank's computer system? Is it a promise from a government you'll never meet? Or is it something more fundamental? Something that holds value because humans have agreed it holds value for thousands of years. The dollar says money is trust. Trust in the system. Trust in the institutions. Trust that the people in charge know what they're doing. Gold says money is reality. Physics. Scarcity. Something you can hold. Something that doesn't require anyone's permission or promise. For 50 years, trust has won. The dollar system has worked. It's created the most prosperous period in human history. But trust is fragile, and once it breaks, it's almost impossible to repair. Central banks know this. That's why they're buying gold, not because they've lost faith in the dollar, because they want insurance in case faith isn't enough. You can see it in the data, in the quiet accumulation, in the diversification strategies, in the public statements about reducing dollar dependence. It's not panic, it's preparation. And if central banks are preparing, maybe you should be paying attention. Here's what nobody tells you. The war between the dollar and gold isn't about which one wins. It's about what happens when the current system becomes unsustainable. And every system becomes unsustainable. Eventually, the question isn't if, it's when. And what comes next? Maybe it's a new Bretton Woods, a reset, a global agreement on a new monetary standard. Maybe it's a multipolar currency world, dollars and yuan and euros and digital currencies all competing, all valid. Maybe it's chaos, a collapse of the current system with nothing ready to replace it. Or maybe the dollar system limps along for another 50 years. Weakened, but functional. The least bad option in a world without good ones. Nobody knows. Not the central bankers, not the economists, not the politicians, but the smart money is hedging, holding dollars for liquidity, holding gold for security, betting on both sides of the war. Because in the end, this isn't really about gold versus the dollar. It's about understanding that money is a tool, and tools can break. Think about the people watching that broadcast in 1971. They had no idea their money had just fundamentally changed, that the dollars in their wallets were no longer backed by anything tangible. Their lives continued. The grocery store still accepted dollars. Their paychecks still cleared. Nothing felt different. But something profound had shifted. A promise had been broken. A foundation had been removed, and we've been building on that missing foundation ever since. 53 years, trillions of dollars in debt, a global system dependent on one currency controlled by one country. It's worked, so far. But every central bank buying gold is making the same quiet calculation. What happens when it doesn't?